Welcome to Market Matters Media. Today we're talking about a big deal in money stuff. What the Federal Reserve does with interest rates. This affects us all. So hang on tight, we're going to explain how it changes things in the market. Alright, first let's talk about what the Federal Reserve or the Fed is. It's like the main bank for the whole United States. Its big job is to make sure the economy stays steady and healthy. Now, one of the main ways the Fed can do this is by changing something called the federal funds rate. In simple terms, this is the rate that banks charge each other to lend money just for one night. Even though it seems like a small thing, it actually has a huge effect on a lot of other stuff. So what happens when the Fed changes this rate? If the rate goes up, it becomes more expensive for banks to borrow money from each other. That means it's also more expensive for you and me and businesses to borrow money too. This can slow down how much people are buying and doing, which slows down the economy. On the other hand, if the rate goes down, borrowing money gets cheaper. That can make people and businesses more active, giving a boost to the economy. Why should you care? Well, these interest rates affect how much people are willing to spend. If rates are high, you might think twice about buying a new car or house. Businesses might also hold off on opening new stores or creating new products. But if rates are low, people are more likely to spend money, and businesses can grow more easily. So now that we know how the Fed's decisions can make big changes, let's dig a bit deeper into 4 specific areas: how you and I spend money, what it means for businesses, the value of our money compared to other countries, and what happens in the stock market. 1. Consumer spending. When rates go up, borrowing money becomes more expensive for all of us. That means the cost of getting a new house with a mortgage or buying a car with a loan goes up too. So we might decide to spend less because it costs too much to borrow. Remember when the Fed raised interest rates back in 2018? According to the U.S. Bureau of Economic Analysis, consumer spending slowed down in the months that followed. Famous financial advisor Suze Orman even suggested that people should reconsider big purchases like houses or cars. Why? Because when rates go up, mortgages and car loans become more expensive. That can lead to people like you and me cutting back on spending. 2. Corporate borrowing. Businesses also feel the pinch when rates go up. If a company wants to grow by opening new stores or improving what it already has, it might need to borrow money. Higher rates make this more expensive, which can cut into the money the company earns. Companies like Apple or Amazon often borrow money to grow. When rates are low, it's like a golden ticket for them to expand. But when the Fed raised rates in 2018, some companies found it more expensive to borrow. According to the Financial Times, this led to tighter profit margins for businesses, as the cost of borrowing ate into their earnings. CEOs like Elon Musk of Tesla have often commented on how interest rates affect their business plans. 3. Currency value. Higher rates don't just affect us. They can make our money more attractive to people in other countries. If they think they can make more money by investing here, they'll buy our currency, making it worth more compared to other currencies. A good example here is the US dollar. Higher interest rates in the US can make the dollar more attractive compared to other currencies like the euro or yen. According to data from the Federal Reserve, there were times when the dollar strengthened after rate hikes. This can be a draw for foreign investors, including people like billionaire investor Warren Buffett, who look for strong currencies to invest in. 4. Investor sentiment. Lastly, the stock market often jumps or drops based on what people think the Fed will do. If investors think the Fed will raise rates, they might sell their stocks because they're worried other people will spend less. But if they think rates will go down, they might buy more stocks, expecting businesses to grow. When the Fed changes interest rates, big-name investors like Ray Dalio or Warren Buffett often share their opinions, which can sway the market. For example, in 2019 when rates were cut, many investors felt optimistic and the stock market went up. According to CNBC, the S&P 500 gained significantly in the months following the rate cut, as investors anticipated better economic growth. Understanding these four areas helps us see why the Fed's decisions are such a big deal. They can affect everything from our personal shopping choices to how well big companies do, and even how our money stacks up against others around the world. Alright, let's talk about how fast things can change in the stock market when the Fed announces something about interest rates. For example, let's go back to year 2013 when the Fed surprised everyone by raising rates. As soon as the news hit, a lot of stock prices went down. Why? Because investors thought that the higher rates, people will spend less and the economy will slow down. But it wasn't bad news for everyone. Banks were actually pretty happy about it because higher rates can mean they make more money. Now, it's key to remember that what Fed does is just one piece of a bigger puzzle. There are a lot of things that can make stock prices go up or down, like big news events, how well companies are doing, or even how people are feeling about the future. So the Fed is important, but it's not the only game in town. The relationship between the Fed, interest rates, and the stock market is like a complex dance. They're all connected, but are also influenced by a lot of other things. For us regular folks who are buying things or maybe investing in stocks, it's really good to understand this dance. It helps us make smarter choices with our money. Knowing how the Fed decisions might affect the market can give us a heads up on what could happen next, so we're not caught off guard. So while it's true that Fed holds a lot of power, they're not the only factor moving the market. It's a mix of many things, like global events, company news, and how people are feeling. That ultimately drives what happens. But keeping an eye on the Fed can give us useful clues about where things might be heading, helping us make better decisions about our money. To sum it up, the Federal Reserve's decisions on interest rates are a big deal that affect a lot of things. How much we spend on homes and cars, how businesses like Apple or Amazon grow, the value of our money compared to other countries, and even how the stock market performs. Whether you're listening to financial advisors like Suze Orman or big investors like Warren Buffett, it's clear that these rate changes create ripples that touch nearly every part of the economy. So keeping an eye on what the Fed does can give us important clues about what might happen next in our wallets and in the wider market. Thanks for tuning into Market Matters Media. If you found this insightful, give us a thumbs up and don't forget to subscribe for more deep dives into the financial world. Until next time, keep your finger on the market's pulse.